The 10 best ETFs every American should know in 2026. Invest smarter. Build wealth faster. What if you could invest in hundreds of America's biggest companies with just one investment? That's exactly why exchange funds are become one of the most popular investment tools in the United States. Whether you're a complete beginner or an experienced investor, the right ETF can help you diversify your portfolio, reduce risk, and build wealth over time. But not all ETFs are created equal. Some focus on growth. Some generate passive income. Others track the entire U.S. stock market. Today, we'll break down 10 of the most widely followed ETFs that many investors consider when building long-term portfolios. This video is for educational purposes only, not personalized financial advice. Let's get started. #10. Small cap ETFs invest in smaller American companies that often have higher growth potential than large corporations. These businesses can be more volatile, but historically they've also offered periods of strong long-term performance. This ETF category is often used by investors looking for additional growth. Number Y. International stock ETF. Many investors only buy U.S. stocks, but international ETFs provide exposure to companies in Europe, Asia, and other developed markets. Global diversification can reduce dependence on a single country's economy. 8-band ETF. Stocks don't always go up. That's why many investors include bond ETFs. They generally offer lower volatility than stocks and can help stabilize a portfolio during market downturns. Number Y. Dividend ETFs. Dividend ETFs focus on companies with a history of paying cash dividends. These funds are popular among investors seeking regular income while still participating in stock market. Number Y. Technology. Technology continues to drive innovation. Tech-focused ETFs typically invest in companies involved in software, semiconductors, cloud computing, AI, and digital infrastructure. They can deliver strong growth, although they may also experience larger price swings. Number Y. Nasdaq 100. The Nasdaq 100 tracks many of the largest non-financial companies listed on the Nasdaq exchange. It provides heavy exposure to technology and other fast-growing industries. Many long-term investors use it to capture growth in innovative businesses. Number Y. S&P 500. One of the most popular investment choices in America. And S&P 500 tracks approximately 500 of the largest publicly traded U.S. companies across many industries. For many investors, it's considered a simple way to own a broad slice of the American economy. 3 menos total unes. Stock market. Instead of owning only large companies, this type of ETF includes large, mid, and small cap U.S. stocks. It offers broad diversification across thousands of businesses. Number A. Growth. Growth ETFs focus on companies expected to increase earnings faster than average. These funds may perform well during strong economic periods, but can also be more volatile. Investors often choose them for long-term capital appreciation. #1 all-in-one. Diversified ETF strategy. Many experienced investors keep things simple rather than chasing dozens of funds. They build a diversified portfolio using a few broad market ETFs that provide exposure to U.S. stocks, international stocks, and bonds. This approach can make investing easier while maintaining diversification. Final tips. Before investing in any understand what the ETF owns. Check its expense ratio. Make sure it fits your long-term goals. Stay invested consistently instead of trying to time the market. Review your portfolio periodically as your goals change. Remember, successful investing isn't about finding the perfect ETF, it's about staying disciplined over the long run. If you enjoyed this video, Like, subscribe, and turn on notifications for more USA personal finance and investing content every week.